In the world of investing, one question always looms large. What would Warren Buffett do? Buffett has long been a beacon for value investors everywhere in the world. In the book Buffettology, written by Mary Buffett, Warren's former daughter-in-law, she revealed the 9 critical questions that guide Buffett's investment decisions. So grab your notebook and let's uncover these questions one by one to see how we can apply Buffett's legendary wisdom to our own investment strategies. The first question is whether the business has a consumer monopoly. Many of you know Monopoly, the board game where the goal is to dominate the market and eliminate competition. In the real world, a monopoly exists when a single company is the sole provider of a product or service, making it difficult for others to enter the market. For example, back in its early days, Microsoft dominated the personal computer operating system market. Even as of 2024, its desktop Windows software still held a market share of 72%. When Buffett talks about consumer monopoly, he's referring to somewhat slightly different moat. A moat is essentially a substantial competitive advantage that allows a company to protect its market share and profitability. It's like a castle's moat that keeps competitors or invaders at bay. There are 5 types of moats. The first type is the cost advantage or economies of scale. When a company can produce a product significantly cheaper than its competitors. For example, today, Pepsi uses an AI tool called TasteWise to watch millions of menus and recipes online to figure out what people are eating and why. It also relies on AI to analyze how much skin remains on peeled potatoes, which enables the company to save over $1 million each year. The second type of moat is the network effect. It refers to the incremental benefits gained from new users joining the platform, which results in the product becoming more valuable for all users. Platforms like Amazon and Google become more valuable as more users participate, creating a self-reinforcing advantage that is incredibly difficult for new entrants to challenge. The third type of moat is called intangible assets. A company's brand can convey trust or status or meaning, therefore usually the customers stick to the strong brand. The last type of moat is switching costs, and this refers to the efforts either financially or non-financially for customers to switch to alternatives. For example, most people use Google Chrome to search, Gmail to send emails, use the same account to share files on Google Drive, as well as to watch YouTube videos. Think about the hassle of having to give up your Google account and start over. Other examples like Adobe and DaVinci Resolve. I use DaVinci Resolve to edit my videos and Adobe Photoshop to do my thumbnails, and I wouldn't easily change any other way just because I like their particular features and I'm getting used to them, although DaVinci Resolve is not a public company. If the company has a unique value proposition which sometimes can't be quantified, such as a strong brand with stickiness and loyalty, but it will be evident in the company's income statement. I'm taking one of Buffett's favorite and longest held stocks, American Express, for example here. There are many metrics that you can refer to get a glance at a business profitability. There are gross profit margin, EBIT, earnings before interest and taxes, operating margin, EBITDA, net profit margin, and basic earnings per share EPS. I normally would like to see 3 metrics. Number 1 is the gross margin. You use revenue minus cost of goods sold divided by revenue. This metric indicates pricing power. Higher than industry average gross margins suggest a strong brand or product differentiation. The second metric that I would like to see is the net profit margin. Use the net profit, which is the net income divided by revenue. And this metric can give investors a snippet to see if a company has generated enough profit after the cost of goods sold, operating expenses, interest, and taxes. For the last one, I would like to see the basic earnings per share, EPS. It gives us a direct look at the profitability available to shareholders on a per share basis. As Buffett's second checklist question is related to this, I'll elaborate later. From the data, we can see that AXP's gross margin and net profit are both lower than those of the financial sector, so Seeking Alpha give it a C and C- rating. However, its profitability grade is A+ overall, as the results take account of the aggregate of all the underlying metrics, not an average of the grades for each underlying metric. Of course, you can get the cheating card by looking only at this rating score on Seeking Alpha. The second question Buffett would ask is, does the company have strong earnings? And more importantly, is it trending upward? Let me ask you, if there's one core factor that drives the stock price, only one, what would that be? The future expected growth in earnings. The stock market is looking into the future, not now. If a company can generate more net income due to its excellent business model, the stock price will go upward. So after all, this is still a profitability question, but now we look at a metric from the income statement called basic EPS, which is earnings per share. Basic EPS is to use net income minus preferred dividends, then divided by weighted average common shares outstanding. This is the most relatable metric to investors. It is the profit allocated to every individual common share of a stock. The higher the EPS, the better its profitability. You're not necessarily looking for an EPS that is higher every single year. What's crucial is a strong upward trend over time. Moving on to the third question, does the company have a lot of debt? Buffett pays special attention to a company's debt levels because excessive borrowing can pose significant risks. Generally prudent for a company's long-term debt not to exceed its current net earnings. Why? This suggests that the company would theoretically pay off all its long-term debt within a year if needed. To dig deeper, we look at the debt to equity ratio from the balance sheet. And this ratio compares the total liabilities to the shareholders' equity. A high ratio means the company is using more debt to fuel its operations. For companies like American Express, it's important to remember that financial institutions naturally tend to have a higher debt to equity ratio. However, even within this context, we need to compare these ratios to industry peers to gauge relative financial health. Look at the peer comparison chart. You will notice that American Express, along with MasterCard and Morgan Stanley, carries more debt than their peers. And this raises question, is this a strategic choice linked to a specific investments or acquisitions, or is it a potential red flag indicating poor financial management? Moving to the fourth question, we delve into another critical profitability metric. Does the company earn a high rate of return on shareholders' equity? A constantly high ROE is often seen as a sign of management excellence because it indicates that the company is efficient at converting the money it gets from shareholders into profits. Anything above a 12% return is above average. It's important to look at ROE in the context of an industry. For some sectors such as technology or consumer goods, higher ROEs are common and expected. In contrast, industries like utilities might naturally have lower ROEs due to their different business models and capital structures. And Buffett particularly valued consistency in ROE. A company that maintains a high ROE over several years is demonstrating that it has a competitive advantage and can sustain its profitability. The fifth question, does the business retain its earnings? Retained earnings represent the accumulated total of a company's net income that is kept or retained after dividends are paid out to shareholders. For value investors like Buffett, a high level of return earnings suggests that a company has substantial financial strength and commitment to long-term growth. Berkshire Hathaway itself is a prime example, as it does not pay dividends, but instead reinvests profits to fuel further growth. To analyze a company's retained earnings, I typically look at the trend in return earnings over the years in the balance sheet. An increasing trend often signals a company's operational success. The sixth question he considers is how much does the business spend on maintaining its current operations? Buffett wisely points out that you don't want a business that spends excessively just to stay afloat.
Unfortunately, the good businesses, take a Coca-Cola or See's Candy, they don't require much capital. And incremental capital doesn't produce anything like the returns that this fundamental return that's produced by some great intangible. We'd love to have a business that could earn 20% on 100 million now, and if we put $1 billion more in it, it would earn 20% more on that $1 billion. But like I say, those businesses are so rare. There are a lot of promises of those businesses, but we've practically never seen one. There's been a few.
You can get this information by looking at its operating profit margin, also known as EBIT, earnings before interest and taxes, in the profitability section. If you find that operating profit margins are thin, it indicates that the company might be struggling to control costs or that it operates in a highly competitive or low margin industry. The next question is similar to question number 5. Can the company use its earnings to reinvest for growth in the future? This includes acquisitions and other growth initiatives. How well management handle these tasks plays a crucial role in the company's long-term success.
You want to buy stock in a business that's so good that an idiot can run it because sooner or later one will.
This underscores his preference for companies with straightforward, durable business models that don't require exceptional management skills to succeed. However, when exceptional skills are present, they can significantly enhance a company's value. The next question is similar to the first question. As inflation, the cost of goods and services goes up every year, can the business change its prices without affecting its sales? Again, this is a moat question. A company that has a strong moat typically has strong pricing power. The last question Buffett would ask is whether reinvesting back into the business results in the company being more valuable. In theory, when a company reinvests its earnings, these funds should fuel growth, expand operations, improve products and services, or even reduce debt, all of which can increase the company's intrinsic value and push up its stock price. A company that not only generates high returns on invested capital, but also reinvests a significant portion of its earnings at these high returns can achieve what we call compounding growth. This is the holy grail for any business. You may have noticed the ready-made financial data I use from the stock analysis platform Seeking Alpha. If you're looking to dive deeper into companies' financials and investment potential as a value investor, I highly recommend checking it out.
Over a 6-month period, Alpha picks us up a whopping 53% versus the S&P up 17%.
Using the link below will give you an exclusive 20% discount. Now, let's recap the critical factors that Warren Buffett considers when identifying a great business to invest in. Buffett's strategy is deeply rooted in understanding a company's profitability and financial health. Key indicators like high gross margins, net profit margins, a robust rate of return on equity, and a consistently upward trending earnings per share, EPS, are essential metrics that signals a company's financial health. He prefers companies that maintain a healthy balance between debt and assets, ensuring financial stability and reducing risk. Large return earnings with minimal operating expenses indicate that a company is not only making money, but is also managing it wisely. He admires leaders who effectively use return earnings to reinvest in the business, fueling further growth and increasing intrinsic value. And these principles form the backbone of Buffett's strategy and are a fantastic starting point for anyone looking to enhance their value investment approach. By focusing on these areas, you can begin to think like one of the most successful investors of all time. My name is Irene. I'll see you next week. Bye.